Good to see you again, Lewis. How are you?
I'm doing really good.
Good.
So I thought we would just freestyle today.
Yeah. What's on top of mind for you?
For me,
Yeah.
it's very interesting. I've been working a lot on signal strength. What are those? How do you convert your various inputs for attractiveness, like value, growth, whatever it may be, momentum, and how you convert that to an actual signal, and how often? And I've been working with just getting some of the coding more clear on a few things, but and I've also been thinking a little bit more about macro stuff too. So I believe the macro environment is more important now than it has been in years, and it's something to really keep an eye on. And I've also been spending a lot of time on individual stocks, and I'm seeing different individual opportunities like you and I have already been discussing. So I've kind of been all over the map.
Yeah.
How about you?
Yeah, kind of same thing. I've also been knee deep in stocks because there is a ton of there's both an interesting blend of things that look great right now that you can't wait to buy, and things that maybe maybe a little more on the extended part. So I think it's time to again do our homework and stuff. The other focus that I've had is again on factor backtesting, as we discussed in prior recordings. But as I mentioned, maybe this is the update to a session we did a couple of weeks ago, which is we looked at some technical factors on their own for their own merit, and then I started blending that with more of a fundamental set of factors and see, okay, can the two add value to each other, or actually vice versa? Could technical analysis add value to a pure fundamental investment approach? And I'm starting to get some evidence, as we do through our research, that it is the case. For example, if I can state a couple of things that this is fresh off the press, actually just ran that overnight. So if we take one factor, fundamental factor, I use the capital acquisition ratio, which is a factor that essentially looks at companies that have a lot of cash to cover their capital spending and stuff. So those are companies that should be able to invest in good and bad times because they have plenty of cash. And that factor in itself has done exceedingly well if you look at it, right? So it's been a factor that's been rewarded by the market very, very well. So you're starting with something that already works, right? And we have, just if you were to purely select companies using that factor, you would have outperformed the market, both on a risk-adjusted return and an absolute basis. Now, which would be good enough. I can give you a sense for the numbers. For example, the Sharpe ratio of the market for the past, so I've backtested 20 years here, is 0.23, and the top quintile of capital acquisition ratio companies, if you had just invested in the top quintile companies, by that factor, you would have achieved a 0.41 Sharpe ratio, which is a significant improvement over the broad universe. But you would have done that with roughly the same, even little higher risk. So you have a better risk-adjusted return because you pick up a lot of return, but you're doing that with a lot of risk. So your standard deviation is slightly above the market. Your drawdown is slightly above the market. So those are all, this is like, return is not the full story, and even risk-adjusted return is good. But what we want is actually, as we mentioned before, we have a lot of risk focus. So
that's good. So the capital acquisition ratio is appears to add a lot of alpha, if you will, in the top quintile, and then the Sharpe ratio gets better.
Yeah, exactly.
And how does that compare on its own versus, say, percent from high as a risk factor on its own?
Yeah, on its own. So if we look at percent from high, actually the pure technical factor is actually superior. We reach a Sharpe ratio of 0.51. So we knew already from the results we share with everybody a couple of weeks ago that the technical factor applied on its own is actually gives you a much improved risk-adjusted return, and that's what it does. Is it really does a better job controlling risk. It tends to do a better job controlling your downside and
but it doesn't really necessarily have does it have a higher return than the capital acquisition ratio?
Yeah, it has. It's slightly above. I think we reached 10% here. I've got 9.5. So I mean, I don't know if it's significantly higher,
That's
but it
active
does.
Return, right?
Right now, this is annualized return for 20 years.
Annualized return.
Yeah.
For the Sharpe ratio or for the percent from high was what?
The percent from high was about 10%. I don't have that right in front of me right now, but if I remember, it was low teens.
And then the capital acquisition was roughly
9.57. I'm looking at right now. So, basically the improvement, and again the technical Sharpe ratio was on the risk reduction. So you had an improved Sharpe ratio, not because of return capture, but because of risk management. So the assumption here, the hypothesis. Go ahead. No.
Well, the returns are roughly the same.
Yeah, roughly the same. Exactly.
So it's both return and risk reduction in the percent from high, but but there was not was the standard deviation less in the capital acquisition ratio relative to the market?
No, it's higher. Yeah.
Okay, so you did not capture lower risk with capital acquisition. You only captured higher return.
Correct. In a pure implementation, again, that's correct.
Right, and then whereas with the percent from high gave you both higher return and lower risk.
Correct.
Okay, I just wanted to make sure I understood. Okay.
Yeah. So
that surprises me, by the way.
Yeah, and I'm glad you're making us kind of look at the building blocks here, because so we had two pieces of information. So we know some fundamental factors work on their own. We know that our technical factors work on their own. And here was the question of what happens when you combine the two. Does it really help? And we honestly we can't answer that question until you do it. You don't know what's going to come out with the interaction of these two factors. So what I did is something relatively straightforward. Is I said, what happened if I were to apply the technical factor to the top quintile? So I already have a group of stocks that does well on its own, so the top quartile of capital acquisition ratio. And if I further apply the technical factors to select only the best looking stocks from a technical standpoint based on that factor, what would happen? So, well, when you do that process, if you do the math, you end up with a more concentrated portfolio because you're further refining that quintile, right? And when you have a smaller portfolio, you should have more risk. Well, what I found in drum roll please is actually the exact opposite. Is we actually have a portfolio that gives us a slightly lower return portfolio. Like, for example, my return went from, I gave you 9.5 to basically 8.97. So we lost about 0.5% annualized return. But look at what happened to the risk. So both on a total risk, so the standard deviation of return went from 23% to 13.7%. So a significant reduction in standard deviation of returns. And our drawdown, which is something that we certainly like to look at and something that is heartfelt by our client, is this drawdown went from 57% or close to 58% to 40%. So a significant reduction in drawdown. And all we did, again, is apply a very naive technical trading to a universe that already worked, and we've seen some improvement. So the Sharpe ratio went from 0.41 to 0.65. So a significant improvement in risk-adjusted return by doing that.
You're right. We're looking at just isolating one little variable that we're looking at of many, but it just goes to show that how even the single variable like capital acquisition ratio or factor, I should say, even a simple factor like that makes a big difference. I mean, it can make a difference. And I mean, we knew that there was alpha factors and fundamentals. The question was how much and how much more. And the question is, does it add value versus just having no fundamentals at all? That was kind of our question last time.
Yeah.
I'm not sure yet, but what we do know is if you further take those, if you say I must own companies that have good capital acquisition ratios, then I can make it better by just adding a technical filter on it. But what we don't know is if we took the top quintile of the percent from highs and then added the capital acquisition ratio to it, so it's the opposite, right?
Yeah, we could.
What's coming first in your mind? Is it the fundamentals? Is that a bias that we say, oh, I must put fundamentals first because somehow that makes, it makes me, I have less, I'm not pulling away from the pack too much? Or is the data really telling you that you should do it that way? This is the problem that I'm having is that we have biases and we should have zero biases. I'm not criticizing you. I'm just saying it's an institutional imperative that is out there. So, I mean, what I'd like to see is if you do one and add the other, what does it look like? And if you do the other one and add it, what does it look like? That's a difference, right? Because it's what's the primary factor.
It is. I mean, definitely, we had to start somewhere to.
No, I'm not criticizing you. I'm just saying, we don't know. That's really the question. The question is clearly, we know that if you add technicals on top of the fundamentals, it's going to help it. We already know that. But what we don't know is the opposite. Mm-hmm. That's kind of what I'd like to get to. That's why I said is I'd like to see the data showing me the opposite, and then I would be like a believer.
Yeah. Well, we'll do that. So that's again a great setup for an update to this line of questioning. So let's try to.
I'm not criticizing. I was just saying. But the other thing I was going to mention is that I logically I believe having the fundamentals makes sense. But I believe I don't want anybody to misunderstand where I'm coming from. I believe the fundamentals add value for two reasons. One is logically it makes sense that they would, and two, in real time, in real managing money, I've had better results when I do put a fundamental overlay. That's experience, and you can't put a number on that. So I know from experience that if I go and I look at the fundamentals of a stock, I'm less likely to have a ticker time bomb that just explodes on me because there's something there that makes total, you have more margin of safety, like you said. And I know that from experience, but what I haven't seen it in the data yet. So I'm kind of wondering, what is that? What element of that is actually working? Is it the qualitative part or is it the quantitative part? At this point, I believe it's the qualitative part.
I don't know yet, and that's an interesting question. Qualitative is unfortunately impossible to backtest.
Yes.
It would require us to go and simulate those decisions back in time, which is not possible unless you have actual results. So we take proxy, right? We take quantitative proxy for that. Said, okay, those are the characteristics we're looking for. We're able to quantify those, and they find their way into things like capital acquisition ratio, which would be a great companies that has the characteristics you're looking for, and others. I did the same thing for. I wanted to make sure it wasn't style specific. Capital acquisition ratio being again more on the quality and capital efficiency side, and then looking at free cash flow to price more as a valuation type of ratio, and I found the same type of improvement, less significant on the free cash flow to price, but still the same direction of improvement and significance on the risk side. So that seems to be robust across style so far. But reversing that, the approach is interesting and probably a next step that we need to look at. Said, okay, what happens if you start with, I have the same, not bias, but the same hypothesis, and we've talked about this, at length, is that what is technical analysis capturing? Is it capturing something different than the fundamental? And it appears to be so. But if we find that, like you said, if we were to be unbiased, we do both. But if you look at it and you said there is one seems to capture all the other, then what's the conclusion, right? Are you is there anything that is not already priced in from what you're looking at? So you always have to look at, different source of information to improve your decision-making process.
Excuse the noise in the background.
Hi.
I'm in my atrium, and they're doing work on the roads, and so there's noise.
But microphone is doing a good job. We're not hearing anything.
Okay, so the reason why I brought that up is that in some of the backtesting protocols that we've used over the years, you actually do stepwise analysis where you're saying, okay, I'm going to go and I'm going to add each variable. So what you're looking for is multicollinearity. You're looking for the correlation of the factors, and then you're trying to figure out what is really driving it. So it's one thing to say, well, we have an inferior factor that we're improving by putting a better factor to it. It's another one to say we're starting with a better factor, and then we put it in there and it deteriorates. So that would be telling you that it's actually pulling away from what you could be doing. And I believe that there are fundamental things that you do qualitatively that make a big difference. And we talked about this last time, the concept of the S curve and all that, like where's a company in its cycle and all that. But and I think there's tons of literature on fundamental risk forecasting models. Maybe you could talk a little bit about that. Like, I remember one time you were telling me about some forecasting or risk forecasting models based on fundamentals. So in other words, like, here's the debt to equity ratio. Here's all these fundamental factors that should forecast the riskiness of a company. How, in your experience, how has that part of it, how successful have we been able to see those risk forecasts from fundamental data?
It's interesting you mentioned that today, and maybe I'm going to hopefully just punt on this because I just saw an interesting article about this in the FAJ, Financial Analyst Journal. It's a Clark de Silva and Thorley, or extremely highly respected in the realm of factors, and they basically are talking about multi-factor portfolio, but on a risk-adjusted basis, using risk forecast as a way to diversify portfolio. And I was just reading the abstract, so I won't be able to get deep into it. But there appears to be value add into using risk, expected risk, at the style level in a way to build a portfolio. So the answer seems to be the case, and seems to be confirming some of our approaches, which is a little different, but somehow we found that applying a risk adjustment, this was in our technical Sharpe ratio idea, also appears to improve versus a pure absolute return approach. So I think, the risk estimate is always that's the problem, right? That's to estimate that risk. Risk is notoriously hard to forecast. Same thing with correlations. Correlations are variable over time, variant, and very can be spurious, or can be so systematic. So we have to you have to put it all together into your model to be able to take advantage of that information. And then the problem with it is, again, how much you don't want to put an undue amount of weight to a forecast in which you may have lower confidence, right? That's always the issue with risk forecasting. Is like, let's say your R square, or your confidence is 0.2, 0.3. You're not talking about a 0.9 here. So you're talking about something that has information as the best you can get, but maybe not give you the amount of confidence that you would need to do it. So that's always, it's going to find its way potentially into magnifying those errors into your portfolio construction. So yeah.
Yeah, that's really interesting. I was wondering, I kind of wonder, I saw an article about, and I mentioned it in our last call, about how fundamentally momentum is fundamental momentum, basically. And they referenced an article in there that talked about risk forecasting and how the daily standard deviation of returns is a very robust risk factor, and it's more robust and more accurate than, based on their analysis, than what like economists are using, the Garch method and things like that, which tends to try to make adjustments for mean reversion and all that. Mm-hmm. And which I thought that was very interesting, and which got me to think. Now, I wonder how effective a fundamental-based risk scoring methodology is, or forecasting methodology is, compared to just a simple, here is the daily standard deviation of the instrument, and then how does that compare to the actual standard deviation of that instrument in the forward year or forward month, whatever, scale it out. My hunch is that that the fundamental risk factors are actually going to be worse, but I'm not sure. I would like it to be better, because it'd be better to have something that's not a technical risk forecast. I consider standard deviation a technical risk forecast. It's just price. So we can, I guess, argue about whether or not that's true or not, but let's just say it is. If we look at other risk factors like poor margins, poor quality of earnings, poor high debt to equity ratios relative to peers, that kind of stuff, where you could actually look at quarterly data, annual fundamental data from 10Ks, 10Qs. If you can get that data to actually show better risk forecasts, then I would be interested in using that. You and I both know that theoretically they should. And operating leverage, for example, the volatility of the earnings stream, that's got to add more risk to the deal. The level of the stock, the level of volatility in the earnings, the cyclicality of the earnings, and then of course there's some things that you can't know about that business, and then by the time the number comes out, it's a little late. Stock price has probably moved. But it's because risk is a very interesting thing to me, because when we look at portfolio construction, obviously return is our first focus, right? Well, I should say return is our objective, but within the confines of a risk constraint. That's kind of the way we think. So defining the risk constraint and being as accurate as possible is one of our big goals. It's not that you hear us talking about risk a lot. It's not because we're so worried about risk. It's more like we want a parameter. We want to be within a certain acceptable level of risk for an investor, and then just try to hit the ball given that. So that's why we're so, I don't want to say hung up, but so focused on risk.
Well, it is what it's all about. I'll maybe just repeat something I said before, is basically we don't want to take any risk for which we don't expect to get rewarded, right? Right. In return. So that's why measuring and understanding risk, however you slice it, you mentioned about realized risk, which is the standard deviation of returns, is the total risk, right? It is our observed realized risk in a portfolio of equities, right? In this case, there's no other risk than what you experience in your.
Can I just add something to that?
Yeah.
Because I agree with you. We should not take any investment that we don't get compensated for the risk. That's one part of it. That's kind of the threshold of should I trade it or invest in it. But there's another side that's is equally important, I believe, and that is that you should size appropriately based on the risk. Because and there's lots of studies. I can't remember the name. Black Litterman, the model that was developed years and years ago on asset allocation. There was an observation by the Goldman Sachs quant team that forecasting volatility is a lot easier to do than forecasting return. So I think, and sizing has everything to do with what you're gonna. So I think it is true that we have to have some threshold. You want to get compensated for risk, but there's also the other side. That's just saying selection, but that's not telling you how much, and how much is the risk thing, which is a function of not only the risk of that one instrument, but also how does that particular security interplay correlation wise with the other things that you're holding. So just as an example, I've been kind of playing around with some ideas on portfolio construction sizing, and I was looking at the correlation matrix concept. And if you can imagine a big correlation matrix, on one side of it, if you do just one side of it, you know, you can't easily get the interplay, the average correlation that an instrument has relative to the whole bucket. If you do both sides, you can go row by row or column by column, and you can see any particular one security, you can see what that average correlation is to that particular bucket that you have at that time in a portfolio. And if you imagine, if you looked at a correlation matrix over time, correlation doesn't stay stable. It moves up and down, and it's mean reverting. So you know, if you can imagine a snapshot of a correlation matrix every day, there's a distribution to that correlation matrix. And that's kind of more of the real world. But my point was going to be that if you look at the correlations right now at a group of stocks, like the stocks we have in the dynamic growth, the average correlation of the stocks relative to each other is really pretty low. Mm-hmm. But then when you look at the actual results, it actually comes out to be higher, like 0.6, 0.7. And so that's a tough correlation. Is a very tough one, and you can overestimate and make big errors by small changes in your assumption of correlation and small changes in your assumption of volatility. So it's really important that you also constrain your assumptions on them, so that if you look at a distribution, like I ran distributions of the Russell 3000, look at the distribution of volatility relative to the market, like a volatility scalar, something like, if you're at the 80th percentile, is something like 0.35 to 0.65 on a volatility scalar. And so that's the kind of stuff I think it's really important to put these guardrails on, because if you let things go too open, you make these parameter errors that are enormous because of the way the math works. So you have to use some common sense with this stuff too. But the signal strength thing is the most interesting one that I've been working on. You know, I have this kind of general idea in my head where you have a single pie, and you called it funds flow, which I think is a great way to talk about it. But if you have a single pie of money in the world, and that pie can get bigger as central banks print more money or whatever, or it can contract. But within that money doesn't go away for the most part. It can be pulled out of the system by the central banks, but that money tends to go somewhere. And you could see, if you can imagine one slice of the pie, you could see money flowing out of one slice to another slice. And I was kind of saying, well, that's the same thing with stocks too. And then how can you instead of having switches on and off, you can have more of a gradual move on and off, meaning being, buy it or sell it, buy it or sell it. Instead of doing that, you can have position size based on the signal strength that is more continuous relative to your other opportunities that you are in. And then that way you're maximizing your money in terms of relative opportunity. And that's kind of some stuff that I'm playing around with right now, and I'm kind of modeling. And so that's kind of one of the things I've been working on this week. And the factor stuff that you're working on is fitting into that, because that's part of the signal strength.
Yeah, that's upstream from the signal strength. So yeah, I mean, it's very interesting what you're saying, and related to your errors about risk. It goes back to what we said earlier, is the danger, and why so many people don't even bother dealing with risk. And I think it's a big mistake, because I think you're leaving a lot of your ability to manage risk in the portfolio construction. But anyways, if you overestimate risk, of course, you're going to be too conservative and not deploy enough capital into ideas. That's the biggest danger. If you underestimate risk, of course, the reverse is true as well. You might be over allocating capital to something that's riskier than you believe it is. So there is no answer unless we have a crystal ball. So we're just trying to put some guardrails. I like that, so we don't go into the extremes and prevent something from happening to the portfolio. So so for us, I mean, I like to cook a lot, so I always look at portfolio construction as a two-step process. First, you have your ingredients, right, which is your security selection. How do you select your ingredients? How do you pick them? Of course, you come up with the best, freshest stuff that you find at the market or in the gardens, and that's your best stocks and your best ideas, right? And then the other thing is you have a recipe. You have a set of techniques and processes that turn these ingredients into something that is hopefully great and delicious. And if you fail, doesn't matter if you have the greatest ingredient, if you fail to execute on that recipe, at least on which would be in our case the portfolio construction process, it's not going to be great. The same way, if you have bad ingredients, even well executed, you cannot improve on bad ingredients, right? So for me, I mean, I think it's the perfect analogy into
that is
to
a perfect
portfolio
analogy. I mean, it really is. I mean, the ingredients are the factors and all that stuff, and then the portfolio construction is a recipe, how you blend it together, and then there's the presentation, how you plate it and put it to your guest.
We eat with our eyes first, so let's call that that's the quality report for our clients. That's the plating right there. So
yeah, that's true. That is so funny. I love that. Well, the stuff that you're working on is really interesting. I'm glad to hear that you've made some progress on that. I mean, I always thought that the EBITDA, the valuation measures, and the return on capital factors were probably the most powerful. Like return on capital is the one that I like the most because it implies a lot of things. It implies profitability. It implies that for every unit of capital that they invest, they're probably, if they can duplicate what they're doing, they can grow faster, which means your money can grow faster. And it also implies a level of quality because there's probably more cash available, and they could probably, it also implies that they're managing their capital fairly well, that they probably are not over levered. I mean, there's so much in return on capital. If you know the DuPont formulas, you kind of back into what I just said, and I know you do better than I do. But it's something that I believe is probably one of the most powerful fundamental factors on the planet.
No, it is, and it does. I mean, it does. The historical results show that. So the most powerful is CFROIC, the cash flow return on invested capital. I think ROIC and ROE do work, but again, the cash flow, cash is king, right? So coming back to cash flow, that's why free cash flow to price is a lot more powerful than earnings to price. And I mean, I think, and that's really, it's about cash, and I agree with that. I mean, that I see why that's a superior variable. It's just the concept. Most people think about things in terms of a net income statement, but backing out some of the accruals and really getting down to that makes, that does make a lot of sense. And it reminds me of, you remember back in the day studying economic value added? Yes.
Out of all the stuff that I studied in the CFA, that was the number one most important thing I ever studied. Because even though maybe it's not a perfect model, its framework is ideal in my mind because it factors in all the elements. And so that I kind of have that in the back of my mind all the time when I'm looking at a stock fundamentally. And even if it's a growth company, because my thought is that, well, can this actually turn into one of those companies where on an EVA basis it makes sense? But you're speculating more. The more you're pulling away from them actually being at that point, and you're kind of saying they will become that, the more you're speculating, and you need to get paid more. I was looking at Peloton today and Pinduoduo, and my gut says sell it. I want to sell that stuff.
Yeah, no, and like I said, I open with that. Like when I look at stocks right now, I think there's some things we want to sell. You mentioned two of them that I think are maybe ripe for us to sell based on where we own those stocks and what we think of them. While other things are certainly coming to looking pretty nice setup right now into different sectors and industries. There's some interesting dynamics in the market right now, and I think we kind of stay on top of that. So I don't want to diverge into a whole nother discussion.
Yeah, we shouldn't talk about individual holdings.
No, exactly. And your EVA idea is fantastic in itself. And I think, from a corporate finance standpoint, in the end, a company has to be sustainable. And if a company is not able to earn its cost of capital, then in the long run, it's not viable or sustainable. So that's the basic of a sustainable ongoing concern as a business.
So this brings up a quick point that I wanted to have you talk about, if you will. We were talking on the phone yesterday, and we got into this discussion about value, and I made the comment that, if I was a corporate finance guy, at some point I'm going to look at the currency that I have, which is an overvalued market cap, and I'm going to say, I'm going to spend some of that and buy some of these companies where there's real cash flow, return on cash flow of 20%, 30%, 50%, whatever it may be. That's what would fill the gap. And then you brought in the concept of private equity. So what is your view on that? Do you agree with me that that's probably what's going to be the catalyst that's going to fill that or revert that gap between value and this in love with just pure momentum without looking at what's going on with the company?
Yeah. We have to believe in that. Otherwise, I think we have a fundamental problem into the way things work. Assuming that corporations, actors are good allocators of capital, they should be thinking the same way you're thinking right now. Said, okay, what is the better use of my capital right now? So I've got so much capital. I need capital. So there's sources of capital. So we think about source of capital as well as use of capital, right? So, right now we're seeing some industries, namely like energy, where we've seen some M&A, major M&A this year so far, where failing or companies that are been hit hard and are not actually, exactly to your point, not earning their cost of capital because they're overly levered, are being taken over by more healthy companies with good balance sheet, right? We saw that recently with anything from Dominion Energy being taken over by Berkshire Hathaway and at least the gas distribution assets, so on. So we're seeing that right now. So we're seeing already evidence in this downturn of allocating capital, using it and to acquiring, in this case, distressed asset probably. But
I agree. There's another thing that we talked about that I thought we'd share with the listeners that I thought was interesting, that we were looking at the difference in the large cap versus the small cap spread.
Mm-hmm.
Normally, the small cap tends to have better returns than the large cap, and there's big institutional money management firms that literally place their entire business on tilting value and tilting small cap, and that's been the wrong place to be, at least in the last 10 years, maybe even longer. But we brought up the concept of indexing. You had mentioned that the index flows now are, the amount of money that's indexed is huge now, overtaking active management. And that, by definition, since most indexes are market cap weighted, that by definition will cause flows to favor large cap. And then that's what led to this conversation of, well, that can't go on forever. If that did go on forever, then you would have we'd be way upside down, right? It would make no sense. At some point, I think what's going to change this is going to be the rational actions of cash flow oriented corporate finance executives, CFOs, who say this is not working, and that gap is going to that spread's going to be closed. And I think that's going to happen. I wouldn't be surprised, JP, if it happens in the next 2 years. And that you have something really big. But I also think a lot of the value companies that we see today that are quote unquote value are really dying dogs. So there'll be a separation of the dying dogs and the real companies that will reinvent themselves by the innovation, and increase their growth rate through that innovation. And that will pull up those mid and small companies.
Yeah. No, I think you put
that's what I think is going to happen.
I think it's the right word. It's calling value something different. It's really, you talked about money flow here. I'm talking about how do we spend as an economy? Where do we spend our money, right? The way we spend our money today is different than 20 years ago and 50 years ago. That's why you see companies and industries being disappearing and appearing. And I think right now we're sitting at that fork in the road where we are seeing emerging business model, emerging entire industries really that are not the same that led us here. So we have to look forward, and that's what we're seeing. Those companies that are, keep going up every day. It's not necessarily some of them are overvalued. Yes, I'm not going to get into that, but when you look at the future, they are gaining market share. Like the entire pie of their industry is getting better. The amount of money being spent is growing. So these companies have a good, it's like the old, the rising tide rises all boats, but then you want a good boat without a hole in it. So I think that's what we're looking for. And right now there's a lot going on, and you don't have to necessarily, it doesn't have to be sexy, like, tech company. It happens in all industries. There's stuff in industrials, and on the automation stuff. There's challenges, there's innovation, there is disruption into a number of industries right now, even down to insurance companies and financial service. I mean, I think we hear a lot about fintech every day in the paper. So those are all things that said, okay, where's the money going to be spent? Is it going to move away from your traditional players into the new players? So where's the puck moving? Who's going to be the winners and the losers is really, for me, this is what excites me when I look at stocks. I'm like, who's the winner in this environment versus who's the losers? And try to put our bets on the winning horse.
Well, this year is going to prove out to be very interesting with the election coming up. We're heading into the earnings right now. So we'll have some good, fun things to talk about next time.
Yep.
So I think we're probably running out of time. But it's good chatting with you. Good to just freestyle, see what's on your mind, what we're working on. We work on these things separately, and then we come back and we find that we work better that way when we're rowing in the same direction, but we're working independently, and we come back and we say, yeah, this is what I'm seeing, this is what I'm seeing. And then we have a collaborative result that is superior than the result that than either one of us would do on our own. And to be able to think outside of your own thinking is really important. And also bringing in other people who have other expertise. We're talking to people that have quant skills in other areas, and their experience set over years of data and managing tons of money. That all that stuff is what makes this business fun. Since we got into this business a long time ago, it's still not boring. Now, my kids think it's boring, but I don't think it's boring.
I can't imagine being boring. I mean, you can't be, because the market is different every day. So,
yeah.
Learning
any
businesses.
Final words, man, before we sign off?
No, I mean, if you need an additional incentive to keep tabs on our little banter, I will provide an update. I think you put some interesting thoughts, challenged some of my work, and provided some additional thoughts going forward. So I will make sure to pursue those ideas and bring them back to into this venue to give you an update. So sounds good.
Very cool. Yeah, I mean, it wasn't really a challenge. It was a curiosity. Like, we just want to know the truth. That's it.
Yeah.
All right, buddy. Good to see you. Talk to you later.
Nice to see you. Later.
Bye.
Bye.